All right, hello everyone, good evening. My name is Jay Garcia. This is Chase and Connor, Derek O'Hanlon, and Harold Catolico. Yeah. And we are with Titan Realty Financial, and we're gonna look at Consulado de Mexico, which is a commercial building, and it's located in attractive and beautiful Orange County, Santa Ana, just like this group said. Low unemployment area, higher business levels, and higher educated vicinity. And for my next slide, we're gonna be going over the overview of our purpose, our description of the location, and a SWOT analysis as well by me, financial analysis, and a synopsis. The main purpose of this building right now, as you can see, the name is Consulado de Mexico, and it's located in 2100 East 4th Street in Santa Ana, and it's leased to the Consulate of the United Mexican States, and it provides Mexican citizens with services and documents, and it's also a multi-family developers, which identifies for next development grounds, so that means that you could also use it as multi-family, though around the area we've noticed that there's actually more businesses, so it actually makes more sense to rent it out this way. Next.
And then for the description of the building, it's about it's 21,000 feet. Built in 1975. It stands on 1.27 acres of land. So $505 million. It's got 2 stories and 101 parking spaces. Location, Santa Ana again. Park Center submarket between the 5 and 55 freeways. 2 miles from the commuter rail, and it's about 6 miles from the John Wayne Airport. Region, again, located in Southern California. It's a 3rd populous county in California. Santa Ana is the county seat, pretty much like the capital of Orange County. Tourists with major attractions, we got Disneyland, Knott's Berry Farm, Angel State Stadium, and plenty of beaches along 48 miles of coastline. Older cities like Santa Ana, Anaheim, and Fullerton have traditional downtowns dating back to the 19th century. And then for community, which our property is located in Santa Ana, 2nd populous city in Orange County. You got the Santa Ana Zoo, Discovery Cube Center, major restaurants, shopping centers. Got newer commercial developments around the area, and multifamily apartment housing.
So I'm going to go over the SWOT analysis, which is strength, weakness, opportunity, and threats. And the main purpose of this, and also this group, what we came to realize is that when a client comes in, there's 2 things in real estate, both commercial and residential. Pretty much these finance decisions could either make you a lot of money, or it could take your money away. It could hurt you. There's a lot of real estate agents out there that are not financial advisors. A lot of them don't know what they're talking about. So with our consulting firm, we do the research. Client comes in and wants to make an investment. Now, before they get excited, it's not good to fall in love with the property. It's better to fall in love with the numbers. So some of our strengths with a commercial building is the tax benefits, obviously. You could write off the MIS, mortgage interest statement, the property tax. There's a lot of expenses that are gonna happen on this property, maintenance, you could write that off. It's a great investment opportunity to bring residual income as well as pride and ownership. And also, you become your own boss. You could be self-employed doing this. And for the portfolio, raises your credit score every time you make that payment. On time, maybe a little extra that's due. And if sold, if there's some extra money that you've made, you have a 1031 exchange, which means that you can actually get the next property and save yourself from capital gains. And scalability, and what that means is you have 2 examples. You could rent a property, you can renovate a property and sell it, but that's just one, right? But with a commercial building, just one property could get you 10 incomes, 5 incomes, 20 if you're at that level. So it's almost like a percentage. In real estate, they say you could have 100% of a grape, But even 25% of a watermelon is still better than that. Also, there's weaknesses. There's low ROI due to high capital gains taken from federal due to laws created from the government. You know, that changes a lot, and lately it hasn't been that well. Most property locations need rehab and work, which requires capital and vacancy due to construction safety. So some of these properties will need some work before you can rent them out. So if they come with tenants, yeah, there's a good chance you're gonna make money right away, but more than half the time you're not. And go back here. Some of the tenants, as we've seen in the COVID pandemic, they're unable to afford the rent, or they become insolvent and can't keep up with the rent agreement, even though you have a contract. Also, you know, we've seen a lot of evictions, especially in California. I know because I've been through that. I have one out of state that I've been through 2 evictions, and the legal services can be costly, but you know, thanks to contracts, you know, we were able to win these lawsuits. And obviously there's another weakness, high taxes. It is California. High interest rates are going up, as you heard from Jerome Powell and the Fed, and inflated housing prices. Houses are going up. Next slide. And the opportunities that obviously we've heard are the rental rates. You know, they're below market, but purchasing this property provides an opportunity because it brings the tenant to market rates upon expiration for a 46.62 for a 2-year internal rate of return, or a 15.48% 10-year internal rate of return. So this identifies the tenants willing to pay market rents, okay? And it also explores redevelopment opportunities. So if you wanted to remodel it, there's another write-off. It could be a multifamily or senior housing. There's ways to collect rent from not just the tenants, but other factors, insurance companies, or even corporate stays from the actual company itself. But there's also threats along with those weaknesses. There's high competition, especially in these times today. For example, performance and cash buyers that, you know, they're not requiring credit, and they're coming from foreign countries, and they're, you know, taking everything. They're taking the supply. And obviously, if there's someone who did have a credit score that was higher than yours, sometimes that does play a factor. Also, historical notes, sometimes one could have a bad credit score, but they do have the money, but sometimes that credit score hurts you and they're not gonna give it to you. And obviously, if you're a recession, before we did this project, obviously there's talks of inflation, high inflation. Today, as a matter of fact, there was more news about BlackRock talking about another recession that's gonna be towards investments and real estate. So it would have been nice to have those numbers and that news brief before we did the presentation. But we're gonna go over to Harold for the financial analysis portion.
Okay, I'll be talking about the financial analysis part of it, kind of what helped us determine if this is a good investment or not. First, we go over the assumptions. The property has an acquisition price of $5.5 million, and the gross potential income is reported for $424,000. And all the other assumptions was given to us by a Chase Bank. If we go with a 60% debt ratio, the loan amount will be $3.2 million, and 10 years later, the loan balance will be $2.6 million. Our annual loan payment will be $200,000, and monthly will be $16,000. The other assumptions, the annual rent increase is 3%. Vacancy was 0% that was reported, but I just put 1.5 for safety insurance just in case, especially if it's into a multi-family development. Annual expense increases by 2%, expenses 31.2. The holding period is 10 years, and the property reported a capital rate of 5.34%. Selling expenses 4%, and discount rate 8.5. For the gross potential income, the first year, as they reported, $424,000, and the net operating income gets subtracted by the expenses and the vacancy factor of 1.5%. The vacancy factor of 1.5% is about $7,000 only, so the expenses was about $130,000, and it becomes a net operating income. I put it for the first year, and it trends up the next 10 years. So with the 287 net operating income, it gets divided into two portions, into 200,000 for debt service and the 86,000 cash equity that you keep. So those two, orange and gray, equals the net operating income. And for the next 10 years, the debt service stays consistent. And as you see, the cash equity actually increases close to 200,000 as the net operating income increases. So with the gross potential income, after you subtract everything, the vacancy factor, expenses, and the tax rate from the operating income, you actually have 67,000 left for the first year, and you can see a slight trend increase for the next 10 years. So for the first part, if you put what you put into equity of 2.2 million in the beginning, and each step that's the price you have to keep paying, which is the vacancy factor, expenses, and the tax. You also get to keep the profit, which is the equity. So just to break it down right here, it's the 1.5% vacancy factor, plus the expenses, plus the debt service that you have to keep paying, tax, and then you subtract the cash to equity you keep that you can pay for the next year. And over the next 10 years, it builds up to be 4.9 million, and on the top left, the current price right now is 5.5 million. There's a breakdown for that step, 7,000 for the vacancy factor, 140 for expenses, the 200 debt service stays consistent, the tax rate is, the tax is 31,000, and you subtract your cash to equity that you get to keep for next year. So this is with on the bottom left, the 60% debt ratio. And the reason we chose the 60% was because it gave us a higher NPV. So if we play around the numbers and we use the 20% debt ratio, you actually see that after 10 years, or actually after 6 years, you start gaining a little bit more than what you did with the 60%. But we kept assuming with the 60% because that's what the bank gave us. And at the end of 10 years, at the end of 10 years, you would have spent only 4.4 million for a current price of 5.5 instead of the 4.9 with the 60% debt ratio. So the comparisons between the two, if you use a 20% LTV, the NPV is 129. But if you use the 60% that we keep assuming and we use all the parameters for, the NPV is actually 672,000. And Jason will be explaining the loan payments.
Hello everyone, my name is Jason, and as several times this semester, Dr. Foss has talked about, you want to pay off your mortgage, not maybe ASAP, but you want to get it eventually paid off debt-free is the best kind of debt. And I think Foss is on his third house payment, correct me if I'm wrong, paid off. With that being said, I'm personally a fan of the bi-weekly payment, and as you see, with roughly not even $600 more, if you make bi-weekly payments on the mortgage, you're paying $8,359 26 times a year versus the monthly payment of $16,178. And in the long run, you'll shave off 51 months of payments, so that's over 4 years. And this is assuming the same interest rate. Our interest rate is 4.5%. And how many of us are paid bi-weekly that can kind of understand this and apply this to a car? Because I don't think many of us have commercial real estate just yet, but hopefully after the class. Next, the same principle applies to weekly. So many of us get paid weekly as well. So the more times you make a payment, the more compounding there is to get this paid off. And if you make weekly payments, assuming close to 30 years, you'll save 92 months. And at the 268th month, you'll have the whole property paid off. And that's just, once again, that's assuming 4.5%. During volatile times like 2021 and 2022, right now might not be the best time to refinance, but certainly in 2021. So you could borrow a large stake from your property and you have opportunity costs such as other real estate, the stock market, or possibly venture capitalism. Or you could do a mix and match of both. For example, maybe, let's say you borrow $500,000, you put $250,000 in S&P 500 and $250,000 in another real estate property. And the reason why I say the stock market, while you already have this acquired commercial real estate, is because there's more liquidity there. So during tough times, you can't really pull out of a commercial real estate, and or if you invested in a new restaurant or a new tech business, there's not a lot of liquidity there. So I think now we're gonna give it to Jay for the conclusion.
So my consultants and I have declared that we agree on this proposal for our client. Our net present value was actually positive of $672,236 after 10 years, and a passive income of about $150,000 annually, as well as a gross potential income. This pays for the following: the 1.5% vacancy factor, which Harold did mention, expenses, which commercial will have a lot of expenses, debt services, and also property taxes, and as well as everything else that comes with it. And with that in mind,